Hey everybody, this is John and welcome to my YouTube channel, Retire Well. Hey, in this episode today, we're going to talk a little bit about capital gains. In a previous video, we talked about how ordinary income is taxed. We look at the tax brackets, talked about the marginal tax rates versus the effective or average tax rates. Really looked at those tax brackets and how they work. Today, I want to focus a little bit more on capital gains. If you like what you see here on this video, please hit the like button. Also, if you'd like to be notified about future videos that come out on my channel, please hit the subscribe button. So before we start talking about capital gains and how they're taxed, I think it's important to talk about what is a capital gain. Well, if I own an asset and I sell it at a profit, that could be a stock, a mutual fund, ETF, a bond, even real estate. If I sell it at a profit, I have to pay tax on that profit during this tax year. That's a capital gain. And so how that's classified is either a short-term gain or a long-term gain. Short-term gains are if I've held the asset for less than 1 year, and if I wait till at least 1 year, then it's taxable as a long-term capital gain rate, which is a different tax rate. It could be a different tax rate altogether. So what I do for my clients every year, I produce a tax report for them. And so they give me a copy of their tax return, I review that, and we produce about a 1 or 2 page tax report that shows all the pertinent details about their tax situation. It's really useful. We refer to that throughout the year. We're talking about ordinary income, we're talking about capital gains and what to do with that information. So I want to show you just a sample of one of my tax reports. And so in this particular example, you're going to see this couple had about $178,000 in total income. They had some deductions which knocked their actual taxable income down to about $150,000. And so, as you can see in the bottom section of information, you'll see that they had about $23,000 in long-term capital gains, and they also had some qualified dividends. So, long-term capital gains and qualified dividends are both taxed at the same rate, approximately. And so, I want to talk a little bit more about that. So, if we look at their actual tax brackets, you'll see that they're actually in the 22% tax bracket. And you'll notice out to the right, it shows that they have about $125,000 in taxable income. Well, wait, I thought they had $150,000 taxable income. Well, 125 of that is taxable as ordinary income. And so that's taxable at this 22% rate on a marginal basis. Anywhere from $80,000 to $171,000 is taxable at that 22% rate. Their capital gains, on the other hand, that's taxable on a different schedule. So let's look at the capital gains table for any long-term capital gains or qualified dividends. And so you'll notice that off to the right, they had $27,000 in long-term capital gains or qualified dividends, and that's taxable at a 15% rate. And that's based on their total income of $152,000. So you can see if they didn't have a lot of income at all, they might even pay zero in capital gains tax. If they had a lot of income, they might pay tax as high as 20% on those long-term capital gains. So very useful information. So for a lot of people, long-term capital gains can be much lower than ordinary income tax. And so that can affect our decisions on how we buy and sell our property. So how do we put this into practical use? So I created this hypothetical portfolio, a handful of stocks here. You can see about the top 4 stocks there, they actually have a loss. Those are in red. And then the rest of those are at gains right now. And so you'll notice that just for simplicity, I made sure all these were long-term. They've been all held for more than 1 year. Okay? So let's say that in this portfolio, I wanted to sell Microsoft. Well, that has a $13,000 unrealized capital gain right now. So if I sold that, I'd be on the hook for a 15% capital gains tax based on the income that we saw in the previous charts. So 15% of $13,000 is $1,962. So that's how much tax I would have to pay if I sold Microsoft. Now, so what if I offset that gain with losses? We can actually do this. So let's go up to the top and look at that Tesla position. So what if I sold Microsoft and then sometime within the same calendar year, I actually sold that Tesla position? Well, so I had a $13,000 gain on Microsoft. I have $14,000 in losses on Tesla. So the losses completely offset that capital gain. So instead of paying close to $2,000 in tax on that capital gain, I don't pay anything. That loss actually offset it entirely. And I even have a couple $1,000s leftover losses that I can apply towards another capital gain, or maybe if I can't use it this year, I can actually carry it forward to future years. Okay? So that's one example of how losses can offset capital gains. So let's say I'm not really selling any stocks for a profit. I just am looking at my portfolio and I see that I have some red in there. I have some losses. And one strategy might be, it's called tax loss harvesting. And so the strategy just means that I'm actively looking for losses. Nobody wants losses, but if they're there, you can take them, and there's an advantage from a tax perspective. It just makes your portfolio more tax efficient. So let's say I'm looking at this portfolio hypothetically, and I'm seeing, hey, I got several positions that are at a loss currently. I don't really have any capital gains that I need to offset right now, but I'm just going to sell these investments and go into something else. It could be another stock, could be a mutual fund, ETF, anything. And what I've done, I've harvested that loss when I've done that. So if I didn't have any other capital gains this year, well, what I can do is I could carry that loss forward to a future year. And so those are called loss carry forwards. So those can come in really handy. I remember back in 2008 when the market was 40% plus drop that year. And then a lot of people, if they were actively tax loss harvesting, they racked up a bunch of losses that year. And basically for the foreseeable future, in the next several years, when they had some capital gains as the market recovered, they really didn't have to pay a lot of tax because they were actually able to carry those losses forward for several years until they run out. So that could be one effective strategy to using those losses. So hopefully this explains how capital gains work versus ordinary income. And we looked at a hypothetical portfolio just to show the use of those capital gains and capital losses to make your portfolio more tax efficient. So if you have any other questions, you'd like some clarification, if you'd like me to produce another video on a certain topic, please contact me directly. My information is in the About section of my YouTube channel. And thank you so much for watching this video.